And welcome to ETF Edge. This is CNBC's newest show dedicated solely to the $3.5 trillion ETF market. I'm your host, Bob Pisani. Each week we will break down the biggest trends and help you build the best portfolio using exchange-traded funds. Today we are joined by Tom Lydon of ETFtrends.com and Sam Masucci of ETF Managers Group. Let's get started with the big story of the week, and that's bank earnings, kicking off with Citigroup this morning. Got JP Morgan, Wells Fargo tomorrow, Bank of America on Wednesday. Financials are higher right across the board on the heels of Citi's results. Check out the XLF. This is the KBE and the KBW, all outperforming the broader markets in general. Let's drill down a little deeper on these. The XLF is the ETF that tracks the financial sector in general for the S&P 500. Some of its top holdings include JP Morgan, Citi, and Berkshire Hathaway. This is a market cap weighted ETF, so the top 5 stocks in that make up more than 40% of it. Then there's the KBE. This is an essentially equal weighted ETF and contains names like Regions Financial and Bank of the Ozarks. Tom, how would you recommend playing the financials here using ETFs?
Yeah, well, if you look at the XLF, Bob, and you look at Citi earnings, it's not as though lending and credit card business is bad. It was actually pretty good.
No, it wasn't.
So it was the capital markets that got hit on the chin. We saw the fixed income side of Citi disappoint by 21%. Now, if you remove all that and you look at the pure banking aspect of it, and you look at KBE, these are small, mid-sized banks, well-diversified, equal-weight portfolio, and as interest rates continue to rise, this is the bread and butter of the banking business,
right.
And I think long-term, that's a better play.
But we get into this debate all the time, equal weight versus market cap weight. With the XLF, you're owning a lot of insurance companies. The biggest banks have the huge weighting in there. With
Berkshire Hathaway.
Berkshire Hathaway is a good percentage of the whole thing right there. But with the KBE, equal weighted. So what do you want to own? Is there a time where it's better to own an equal weighted index versus a market cap weighted index? How do you advise people?
Well, investors and advisors are lifting up the hood and they're smelling the beta. They're finding out what in fact is underneath in that index. And in this case, it's more of a pure play to have the KBE because you're actually buying banks. And number two, it's U.S. oriented, not foreign oriented, because a lot of these big banks are affected by global currencies. They're by global markets. They have a huge effect on the overall performance of these stocks.
And Sam, maybe the problem is, given that the banks were all down about 20 or 30% last year, is nobody wants to own them because they're not very interesting anymore. There's not a lot of growth. Now, there's an ETF out there, iPay, Global Payments ETF. Maybe FinTech is the way to go. Maybe you should be owning PayPal and MasterCard and Visa instead of Bank of the Ozarks.
Yes, and I agree. I just think the banking sector is not sexy, and the advisors and the investors we speak to are looking for the more interesting plays. FinTech is very interesting. When you look at iPay, it's up over 40% since we first launched it. IPAY,
right.
Which is a mobile payments ETF. $22 billion of Cyber Monday was done through mobile payments, up 50% year over year. So it's an exciting place to be.
Now, how do you create this iPay? What's in it, and how do you weight it? I always want to know what decisions you make. Is it market cap weighted?
So it's a modified market cap. We are looking for pure plays. We're a thematic ETF shop. We always want to offer pure plays. Top holdings: PayPal, Visa, MasterCard, Amex. These are the type of companies that we want to own.
How did that perform last year?
It was up about 2% last year. It's up over 40% since we launched it.
Well, up 2% isn't fabulous, but considering the KBE, the bank ETF, was down 20%?
Yeah, and when you look what Sam is saying, where's banking going? It's all going online. This is the future. These are the future FANG stocks of banking.
Yeah. So I'm getting back to this idea, is it your opinion that investors should stop worrying about trying to pick bank stocks and simply go where the action is? Essentially, the action's in FinTech, right? That's what investors care. That's where the growth is.
It is. The growth is there. People are looking for tremendous growth opportunities in new technologies, disruptive technologies, and certainly in this sector, it's mobile payments.
Okay. Yeah. Let's turn our attention now to technology, because as the space has come under pressure, Sam, you have one so-called disruptive tech ETF that's actually beating the market over the last year. What are you looking at right now?
I mean, we've got, we like Hack, we like AIEQ. 75% of our fund launches are first to market. So we're looking for narrow sectors in new technologies and offering people that kind of access.
So talk about AIQ, because that's a real interesting dynamic.
So AIQ is the first ETF whose portfolio, and it's an active portfolio, is run every day from artificial intelligence. Watson is picking the stocks.
Now, I want to make clear, this is not an ETF consisting of companies that are engaged in artificial intelligence. You are using artificial intelligence to pick stocks.
Correct.
And it's powered by Watson, which is IBM's
powered by Watson, IBM.
AI system.
And literally it's looking at 6,000 stocks every single day, millions of pieces of information to whittle that down to a portfolio of 75 to 100 stocks.
And what are you using? What's the primary criteria? There's got to be weightings here.
It's looking for value, and it does that based on what it expects to happen in a particular sector. It is sector agnostic. Number one holding, Alphabet, owns a number, Amazon, Netflix,
Texas Instruments, Costco.
So Bob, what they'll do is they'll go in and look at all the financials, 10Qs and that type of thing, but on top of that, they'll dive into social media and find out what social media is saying about the underlying constituents and weight the stocks that way.
But it's not a formula for making money. It was down 7% last year. I know you had Amazon. Certain stocks dove at the right time.
It was down 7%. It's artificial intelligence, and the machine is learning every day.
Okay. Hack, cybersecurity. Yes. Now, this is a much more narrowly, this is a clear thematic one, focused on companies that are providing cybersecurity services?
Yes. So Hack was launched back in 2014, the first cyber ETF. It's $1.4 billion under management, the largest in the world. Companies like Cisco, CyberArk, Symantec. Look at what's going in cybersecurity. It's just incredible, right? You had Marriott being hacked. Hundreds of thousands of people impacted by that. Great increases in the number of corporate dollars being invested in the protection against or for cybersecurity, and so it's at the right place at the right time. Hack has just been a tremendous fund.
Just financial services alone, Bob. I serve on a couple fund boards. We spend more time talking about cybersecurity than we do fund valuations.
But the space has exploded. This disruptive technology space. There's a dozen of them that are already out there. You have a favorite, ARK, A-R-K-K.
A-R-K-K.
A little similar here.
It is, but it's actively managed. So there's this group.
This is disruptive technologies in general, whatever. Robotics,
it's got robotics, AI, it's got DNA, genome sequencing, areas of the market that really, if you're looking for the future of technology stocks, it's all here. I mean, here's the thing. You and I are going to go in and get our annual physical in a couple years. They're not only going to have our blood tests, they're going to have our DNA, and they're going to tell us what's coming. This is all part of these types of stocks that we can invest in today that we don't know much about.
So you've got here Tesla, Stratasys, Square, Intellia Therapeutics, NVIDIA's 5% of the weighting. I know you're not running this yourself, but you like this.
That's right. And it's very high conviction. There are about 30 stocks in there, but it covers all of the futuristic technology sectors.
Yeah. Is there any evidence that the public is driving these stocks up dramatically? I mean, when things got bad in October, a lot of these stocks that everybody loved were sold off because they're high beta names. So the guys who were the momentum guys dumped these stocks even more readily than low momentum stocks. So if you're just going back to the absolute investor, what do you tell them during a period of volatility like that?
If you like the theme, if you believe in the ETF, you believe in the sector, you continue to invest more. I think MJ is a perfect example of that. Our medical marijuana fund grew its assets during the greatest periods of volatility because people are investing in that industry and for the long term, and they're using the ETF to get that access. They want to get rid of single stock risk, and the ETF provides that opportunity.
Yeah, you look at what Amazon did back 10 and 15 years ago, there's twice that it went down by 90%. So these future technologies are surely going to be more volatile than the regular market, but if you've got smart people on Wall Street with high conviction in certain areas and showing performance, it's something you need to consider as opposed to your grandfather's technology.
Yeah. Let's move on, because I want to talk about investing in thematic ETFs a little. This is a little myth busting. We want to do this segment regularly where we debunk some common misconceptions about ETFs. So today's story we want to talk about. Investors should avoid narrowly focused ETFs, exactly like the kind of ETFs we've just been thinking about. Tom, what do you think of this idea? The New York Times ran a story on this yesterday talking about potential risks of investing in tiny little niches of the market. ETFs have now made this possible.
Well, absolutely. I mean, diversification for the average investor makes a heck of a lot of sense. However, just the subject that we're talking about right now, what about these new themes that are going to be the future 5 and 10 years ago that we can invest in now? So the argument is this: have a core portfolio, and there are a lot of core market-weighted ETFs out there for the average investor, which is great. However, take advantage of what Wall Street has to offer. And there are some themes. We've talked about cybersecurity, for example. That is not going away. Marijuana is not going away. These are certain areas that if you can do it in a diversified format, it's worth it for a small amount of your money.
Sam, you've made a whole business out of niche ETFs.
That's right.
Your entire raison d'etre, I love saying that, is based around thematic ETFs. What do you say when people say, you know, you're getting people involved in tiny little areas of the market, they might go up a little bit, then they can blow up spectacularly? What do you tell people?
I mean, our ETFs are in industries and sectors that people are looking to gain access to. We help them get rid of single stock risk. These are highly researched indexes that these are based off of. And it's a great portfolio option for people that want to invest in new tech.
So how do you tell them to invest? Do you do the usual, well, you shouldn't put more than 5%. This is my favorite line. Of, you know, this is like play money. On your side here, you have your core portfolio, your S&P and your Russell 2000 and your NASDAQ 100. But what do you tell people?
We're not recommending portfolio allocations. We're giving them merely tools to gain access to cyber, medical marijuana, mobile payments, gaming. And then they and their advisors should really decide what is the best portfolio allocation.
For the average investor, if they just move from actively managed mutual funds with high expense ratios to core ETFs, they're going to save themselves between 1% and 2% a year. We know that. But
well, let's try to do some portfolio recommendations, because every week we're going to end each show with our model portfolio. We want to show you how to build one of these. Tom, you brought along a broad-based smart beta idea for us today, and we specifically asked you, put a global ETF together, a series of ETFs that have true global exposure.
Yeah. So with this whole idea that investors are waking up and smelling the beta, low cost isn't always the best benefit. And we take, for example, the S&P 500. And this ETF, the first one, RSP, is an equal weight S&P 500. Why today should the #1 S&P 500 stock be 300 times more weighted than the one on the bottom of the list? We show that over time, and this
Talking
is
about Amazon versus whatever the bottom one is.
Right, and this performance is 1 to 1.5% better than the S&P 500 over the last 10 years.
And you can get it for 20 basis points.
And you can get it for 20 basis points. Great. The other
$20 per 10,000 a year. That's pretty cheap.
It's pretty cheap. The next is the Vanguard Developed Markets VEA. Now, if you look at the PE ratio on this, it's below 13.
This is the developed markets of the world ex the U.S.
Ex the U.S., correct. And so here's your international play for, very low expense ratio, 7 basis points here.
Again, $7 per $10,000 investment.
Correct, right. So there are some great valuations there. Not only that, the fundamental emerging market ETF, which actually has latched on to Rob Arnott's FTSE RAFI portfolio, where you have a fundamental analysis, again, going back to pricing. Why not, in a late stage market cycle, don't you buy valuations, pure quality, over growth in this type of market?
And you've got a bond portfolio, but it's short end, 1 to 5 year bond.
It's short, and it go right up against the Barclays Agg, when the Barclays Agg is way more risky and way more expensive than it was just 10 years ago.
And then you throw in a little bit of real estate, I think 5%, and 5% gold, there's your commodity exposure.
Yeah, it's a good balance, but it's more of a smart beta strategy.
Any thoughts on this kind of portfolio?
I love model portfolios. I love building them exclusively with ETFs. They tend to be lower costs, better tax managed, and it's a great way for investors to go.
You're going to hear a lot more about these portfolios because we're going to construct them for you in different ways and different forms over the next several weeks. Now that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Tom and Sam for joining me today. Thank you for watching. You can find all of our latest videos and the portfolios right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Shakes out.